Day trading professionals like the guys at our firm have a very large playbook of strategies to use in every kind of market that you can think of. That includes options trading strategies that can prove incredibly powerful when used at the right time. I'm Seth Freiberg, the head trader of S&B Capital's options trading desk here in Manhattan, and the professional traders at our firm are well versed in multiple option strategies, and we share ideas all the time to help each other express our trading ideas, like the exchange, which we'll be talking about in this video, where we compared two different strategies for playing the same trading opportunity. I think you're going to find the outcome of one of those strategic ideas to be pretty intriguing, so stick around if you'd like to learn a way to express your trading ideas in a much more powerful way than you might have thought. Hi, I'm Seth Freiberg, and I'm the head trader of S&B Capital's options trading desk. S&B Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely as well as in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Okay, so one of the key reasons for S&B Capital's success as a prop firm is the collaboration that takes place between our traders in formal ways through team trading and in the normal flow of communication that takes place between traders in any solid trading firm. And so recently, one of the very experienced traders on our desk, who utilizes options trading strategies all the time, decided to take a trade on BAC, Bank of America, the second largest bank by assets in the United States. His thesis was that the bank was likely to trade in a narrow trading range throughout the month of December. BAC's earnings were due to be released in the middle of January, and this trader did not foresee really any major catalysts that would drive the stock in either direction in the month of December. Now, if you're a typical day trader, you might be asking at this moment, why would you be interested in a stock that you believe won't move? How can I make any money if I actually believe there will be little to no price movement at all? And actually, in this video, we're going to show you two different methods for taking advantage of that exact situation in a big way. But before I share that with you, I did want to let you know that if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. The approach that this trader decided to take as to his thesis on BAC is to implement what's called a buy right option strategy, which involves the use of equity options. And in order to explain this strategy, I need to make sure that everyone watching the video understands how equity options work. And if you know how they work, just hang in there. This is going to be quick. So what is known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of the put, again, regardless of what price the stock is trading at any time before that option expires. Now, the buyer of the option pays what's called a premium to the seller of the option because the seller of the option is the one taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below market. He could flip them the next day and make a huge profit on those shares in that case. Or conversely, on the put option, even if the market goes way below the strike price of the put option, The buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which effectively puts a floor on how much he can lose owning that stock. Now, on the other hand, at expiration, if you've sold a call and the market closes below the strike price of the call, then unless that call was previously exercised, the call expires worthless and the call seller just pockets that premium. Similarly, if you've sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the call seller just pockets the premium, just like with the call. Okay, so as I said earlier, the trader decided to employ the buy rate strategy to trade this anticipated non-movement of BAC. And so let's say that on December 1st, the trader went ahead and bought 10,000 shares of BAC stock at 43.84, which really isn't a very big trade for a prop trader, honestly. And simultaneously, he sold 100 calls at 44. So first of all, let's take a look at the cash flow of what he did, and then we can explore why he used this particular approach to express his trading thesis. So initially, as you can see, the cost of the 10,000 BAC shares was a total of $438,400, but he simultaneously sold 100 of the 44 calls for $1.14. But remember, each of those options contracts represents the right to buy 100 shares of stock, so you multiply that by 100, and he happened to sell 100 of those, so you multiply that by 100 again, so the sale of those calls resulted in a cash inflow of $11,400. So when you net it down, the entire transaction resulted in a net cash flow of $427,000. Okay, so if we now move forward to the day the options expired on December 17th, you can see that during that 16-day period since he entered the trade, the stock at the end of the day only moved up 4 cents from his original entry price, closing on December 17th at 43.88. So with BAC only moving up 4 cents, the call options he sold expired worthless that day. And so assuming he closed the trade at the end of the day, which merely involves selling the shares because, as we see, the options just expired with no value, the conclusion of the trade is that the shares at exit had a value of $438,800, as you can see from the calculation, and the options expire worthless. So when you subtract out the original trade cost, as we explained before, the result is a profit of $11,800, with almost all of that profit actually coming from the premium on the call options because they expired worthless and they brought in $11,400 in cash, which the trader just keeps. So what the trader and I discussed was that there was a potentially better way to make this trade, and it was a successful trade, no doubt, but it involved a substantial outlay of cash and a substantial amount of risk consequently. And so I suggested that on December 1st, instead of executing that buy right, what if he had done this instead? What if instead, with BAC trading at 43.84, he had sold 500 of the 44.5 BAC calls and bought 500 of the 45 calls while simultaneously selling 500 of the 43 puts and buying 500 of the 42.5 puts. Well, that formation where you sell calls and puts at strikes closer to the market and you buy calls and puts farther away from the market, that combination is what is known as an iron condor to options traders. So let's break down what happened here when we do this. And as you can see, we were paid 92 cents for the 500 calls we sold. So just like before, we multiply those by 92 cents by 100 for each options contract, and we sold 500 of them. And so when you multiply it all out, just the calls brought in $46,000. And as you can see, using that same kind of calculation, we brought in $51,500 for the puts. But remember, we also bought the calls at a strike price of 50 cents higher up at 45 for protection, so we had to pay out $36.5 for those. And we did the same kind of thing with the 42.5 puts, paying out $42.5 for those. And so when you net it all down, it results in a cash inflow from entering into this iron condor trade of $18,500. Now, one thing that I want you to focus on, one really crucial point, is that your broker will only require $6,500 in capital for this trade. And obviously, that's quite a bit less than the buy right trade required you to come up with, which was over $400,000 to enter into that trade. Okay, so now let's move forward to December 17th, focusing this time on the expiration of the Iron Condor trade, contrasting it to the buy right trade. Well, remember, BAC closed that day at 43.88, as we explained in the buy right trade that we looked at earlier. And so let's think about the implications of that, which are pretty incredible for this Iron Condor trade. You see, the calls only have value on expiration day if the stock closes above the strike price of those calls. Why? Because the owner of the call option can exercise his right to buy the shares at a price below market and then turn around and sell them at market for a much higher price. But if the market closes below the strike price of the calls, as they did in this case, then he obviously won't exercise his call, because there's no point to getting them for a higher price than he could by just paying for them in the open market. And so both the calls we sold and bought, both of those would have expired worthless. And the same reasoning goes for the puts. The owners of the puts have no motivation to exercise their right to require the put seller to buy those shares at a strike price that's below what they can sell for in the open market, and so those puts have no value also, and therefore those options expire worthless as well. And so the result of the trade is that all four of the options comprising the Iron Condor have expired worthless, and therefore the trader just walks away with that $18,500 in cash that he received when he entered the trade 16 days earlier. Now, let's compare the two approaches, the buy right and the Iron Condor. And as you can see, while both trades were profitable, the buy right trade ate up way more capital than the Iron Condor did, as you can see plainly from this slide, with the buy right requiring over $400,000 in capital for the trade, while the Iron Condor only utilized $6,500. Yet, the Iron Condor was actually the more profitable of the two trades. Now, there are definitely differences between an Iron Condor trade and a buy right, in that the buy right, while it has theoretically unlimited downside, the worst loss the Iron Condor can suffer is $6,500 to the downside. On the other hand, on the upside, the buy right trade has no risk at all. The trader can make good money if the stock goes up, while the Iron Condor begins to lose money if BAC's shares rise by enough, which is a subject we can cover on another video. But suffice it to say that the Iron Condor's risk is real on the upside, while it's quite a bit less on the downside when compared to the buy right. And so what I'd like you to take away from today's video is that a little bit of knowledge of options trading can open you up to a very large universe of possibilities to express your trading ideas, and it makes sense to arm yourself with that knowledge to broaden your playbook and to, very importantly, allow you to choose wisely between different strategies when you're faced with a trading opportunity that you'd like to profit from. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.